S&P 500 gained 123% from 2020 through late 25, after correcting roughly 47%. In July 2026, it trades between 65K.
Bitcoin's 5-year trailing return has been roughly flat to modest versus the S&P 500's steady compounding, the opposite of the crypto always wins myth. Imagine investing $1,000. Fast forward 5 years later. Look at how that growth adds up. I put $1,000 into Bitcoin. My friend put $1,000 into the S&P 500. One of us had almost double the money, and it's not who you think. Everyone online tells you crypto is the fast lane to rich, and index funds are for boomers. Most Americans lose thousands every year chasing the wrong one, not because they picked a bad investment, because they didn't understand what they were actually buying. By the end of this video, you'll know exactly where your next $1,000 should go, and the one mistake that's cost investors more money than a bad stock pick ever could. Here's the experiment. January 2021, $1,000 into an S&P 500 index fund. Apple, Microsoft, Amazon, all of them. Same $1,000 into Bitcoin.
One is a bet on American business. The other is a bet on scarcity and belief. A currency with no CEO and no earnings. Watch what happens to that $1,000 over the next few years. The S&P 500 line looks almost boring, mostly climbing. Bitcoin's line looks like a heart monitor having a panic attack.
In 2021, it more than doubled. In 2022, it lost over 60% of its value. In 2024, it hit new all-time highs. In 2025,
Let's put real numbers on it. Your $1,000 in the S&P 500, growing at a realistic long-term average of around 10% a year with dividends reinvested, turns into roughly steady. If you bought at the start of 2020 in every recovery, you'd likely be sitting somewhere between 900 today. And that huge range is the entire point. With the S&P 500, 5 years from now, you can make a confident guess. With Bitcoin, you genuinely cannot. But here's what almost every YouTube video like this gets wrong. The single biggest factor in your results isn't which asset you picked. It's the exact day you bought, and more importantly, the exact day you sold. Let me show you why that one detail matters more than your Imagine two people. Person A buys Bitcoin and B buys in November 2021, right before the 60% crash. Same asset, same wildly different outcomes for years afterward. Person B might still be underwater today. Now do that same experiment with the Person A and Person B still end up in roughly the same range, because the index is made of 500 real companies generating real profits every quarter.
Bad timing hurts you less because the underlying value doesn't evaporate. It's not just sentiment, it's actual earnings. This is called volatility, how wildly the price swings without face.
And Bitcoin's volatility is typically 3 to 4 times higher than the stock market's. Higher volatility means bigger possible gains, but it also means bigger possible regret.
And this is exactly where most people lose money. Not because the asset failed them, but because of one specific, totally avoidable mistake. It's the mistake I guarantee at least one person watching right now has made in the last 12 months. The mistake is panic selling during a crash. Bitcoin drops 40% in a month. Headlines scream, "Crypto is dead." You sell at a loss to stop the bleeding. Then 6 months later it recovers, and you miss the entire rebound because you sold at the exact worst moment. This isn't a crypto-only problem. It happens with stocks too. In March 2020, the S&P 500 dropped over 30% in weeks. Anyone who held saw the market fully recover. Within about 6 months, it went on to new highs.
Volatility only becomes a permanent loss when you actually sell during the dip. It only becomes real money lost the moment you click sell.
Second mistake, treating this like a one or the other decision. People either go all in on crypto hoping to get rich by 30, or they avoid the stock market entirely because it feels risky.
And leave their cash sitting in a savings account, earning less than inflation. which is its own quiet way of losing money every single year.
Here's the realistic move. Most advisors recommend use the S&P 500 as your steady, long-term foundation for your retirement. And a small allocation to something higher risk, like Bitcoin, often suggested in the range of 2% to 10% of your portfolio, only if you can genuinely afford to lose. Now, everything I just told you is useful, but there's one strategy that professional investors use that almost nobody talks about on YouTube, because it's not exciting enough to go viral.
It's not a stock pick. It's not a crypto coin. It's a habit. And it is, hands down, the single biggest lever you have for turning 1,100 in the first place. It's called dollar cost averaging, and it just means investing a fixed amount on a regular schedule, no matter what the price is doing, instead of trying to time the market with one lump sum. Here's why it works. Let's say instead of dropping $1,000 all at once, you invest $100 a month for 10 months. Some months you buy Bitcoin at $60,000. Some months you buy it at $90,000. You never buy at the exact top, and you never need to buy at the exact bottom either. Your average cost smooths itself out automatically.
An investor who put $200 a month into the S&P 500 from 2015 through COVID would have contributed about $24,000 total and watched it grow significantly without any effort. Ended up with somewhere around $38,000 to $42,000 thanks to compounding. Not because they picked the perfect month, because they never stopped.
This is also why the S&P 500 versus Bitcoin, which one wins question, is honestly the wrong question. The real winning move isn't picking the perfect asset.
It's picking a strategy you'll actually stick with for years, through the scary headlines and the boring months where nothing seems to happen. Consistency beats prediction, every single time. Quick recap so you don't make these mistakes. Mistake 1, panic selling during a crash. Fix, set a plan. Before you invest, not during a crash.
Mistake 2, going all in on one asset. Fix, keep your core money in something stable like an index fund, and treat high volatility bets as a small slice, not your whole plate.
Mistake 3, trying to time the market. Fix, dollar cost average on a fixed schedule, and ignore the daily noise.
Mistake 4 is checking your portfolio every day. This isn't a scoreboard, it's a decade-long project. Checking daily just triggers emotional decisions. So here's exactly what to do with your next $1,000, step by step. Step 1, decide your split. A common starting point is 90 to 95% into a low-cost S&P 500 index
And 5 to 10% into Bitcoin or another asset you're curious about. Only money you can afford to lose. Step 2, automate it. Set up automatic monthly contributions instead of one lump sum.
Step 3, write down your rule before you invest. For example, I will not sell during a drop of less than 50%, and I will not check this more than once a month.